Last month, new regulations kicked in, making it tougher for first-time homebuyers to get into the real estate market. And now, potential homeowners are facing another major hurdle. For the second time in just over a month, several of Canada's big banks are raising their short-term fixed mortgage rates. Ted Chernecki has more.
If you're in the market to buy or sell real estate, take note. The mortgage landscape is changing, and in the long term, it's not good for buyer or seller. Starting tomorrow, the ever-popular 5-year fixed mortgage rate is going up by 35 basis points at most major banks.
This sends me a real signal that the cost of money is getting more expensive, and this is not going to be the first. I think there's going to be many more, maybe not right on top of each other, but it's certainly a sea change. We are now going to start to look at those higher rates that we've been talking about.
The sea change is being driven by the American economy, which is finally starting to show real signs of life. Unemployment took a significant drop in March to its lowest rate in 2 years. Plus, new, stricter lending regulations worldwide are putting pressure on the money supply, and that in turn is driving up bond markets and mortgages.
The economy is in recovery mode. It's growing. The amount of sort of excess capacity in the economy is shrinking. Unemployment is generally coming down, and over time, the Bank of Canada will be raising rates to contain any future breakout of inflation.
Raising the 5-year fixed mortgage rate was first announced by the Toronto-Dominion Canada Trust Bank, taking the new rate to 5.69%. The move was quickly followed by the Royal, CIBC, and Scotiabanks. It's the size of the rate increase that's surprising.
I would say that we're up 35 100ths. It would not surprise me if by the end of this year we've moved up 1 full percent or maybe 1.25% over where we were. To me, 35 100ths is a real flag because of the amount it was raised.
BC's housing market was already seeing a slowing trend. There could be a short flurry of buying and selling as homeowners lock in with previously guaranteed lower rates. But after that, expect fewer buyers who can afford the higher interest rates, meaning those sold signs could become fewer and farther apart.